A lot of people have been asking me why I sold Apple and Bank of America. And I'm going to be straight with you. These weren't little trims. We're talking about tens of billions of dollars. Stocks, I spent years telling everyone, from shareholders in Omaha to folks watching CNBC, that these were the kinds of businesses you want to own forever. So what changed? Did Apple suddenly become a bad company? Did banks stop making money? No, nothing like that. But here's what you need to understand. When I sell something I love, I'm not making a prediction. I'm making a preparation. You know, I've been doing this for over 70 years. I've lived through more market cycles than most people have birthdays. And I can feel something in the air right now. It's not panic. It's not fear. It's something more subtle. It's the smell of excess. It's the sound of confidence that's gone just a little too far. And when you've been around as long as I have, you learn to recognize that smell. Now, I'm not here to scare you. That's not my style. Fear makes you do stupid things. But ignorance makes you do even stupider things. So what I want to do today is walk you through exactly what I'm seeing, why it matters to you and your family, and most importantly, what you should do about it. Most people think a market crash is like a lightning bolt. One day everything's fine, the next day it's chaos. But that's not how it works. A real crisis, a real crash, it builds slowly, like a levee that's been holding back water for years. You see little cracks, little signs. And most people ignore them because, well, the levee's been holding for so long until one day it doesn't. I've got over $150 billion sitting in cash and treasury bills right now. That's more than Berkshire Hathaway has ever held. And people keep asking me, Warren, why aren't you buying? Look at all these opportunities. But see, that's exactly the question that tells me we're not at the buying point yet. When everyone sees opportunities, when everyone feels confident, when everyone thinks they're a genius because their portfolio went up 20% last year, that's not when you buy. That's when you get careful. My friend, I want you to think about something. Every single person who lost serious money in 1929, in 1987, in 2000, in 2008, every one of them thought they were being smart right up until they weren't. They had reasons, they had confidence, they had experts telling them everything was fine, and then it wasn't. Now, I'm not saying we're going to have a crash tomorrow. I'm not saying sell everything and hide under your bed. But what I am saying is this: the rules of the game haven't changed. Gravity still works. Math still works. And when things get stretched too far in one direction, they eventually snap back. You understand, when I dump stocks I once loved, I'm not being emotional. I'm being mathematical. I'm looking at what I'm getting for what I'm paying. And right now, in a lot of places, the math doesn't work. The risk I'm taking isn't being compensated by the return I might get. So I wait, I hold cash, and I stay patient. Over the next 45 minutes or so, I'm going to show you exactly what I'm seeing. I'm going to walk you through the warning signs that are flashing right now. I'm going to tell you stories from past crashes, not to scare you, but to show you the pattern. Because history doesn't repeat exactly, but it sure does rhyme. And I'm going to give you a set of rules, simple rules, that will help you not just survive what's coming, but come out the other side in better shape than 99% of people. See, the goal isn't to predict the future. The goal is to be prepared for multiple futures. And right now, one of those futures involves a lot of pain for people who aren't ready. But here's the good news. You don't need to be a genius. You don't need to time the market perfectly. You don't need to know exactly when or how things will unfold. You just need to understand a few basic principles and have the discipline to follow them. That's it. I've made most of my money by being patient and being rational when other people were being impulsive and emotional. And you can do the same thing. Not because you're Warren Buffett, but because the principles work for anyone who applies them. In a minute, I'm going to show you the 3 specific things I'm watching right now that tell me we're closer to trouble than most people think. These aren't complicated indicators. They're simple. And once you see them, you won't be able to unsee them. You'll start to understand why I'm sitting on all that cash. And more importantly, you'll start to understand what you should be doing with yours. Now, let me walk you through what's actually happening right now. And I want to be clear about something. This isn't about doom and gloom. This is about reality. Because if you understand what's really going on, you can make better decisions. And better decisions over time. That's what builds wealth. So here's what I'm seeing. First, valuations. I've always said that price is what you pay, value is what you get. And right now, the gap between those two things is wider than it's been in a long time. We're not quite at 2000 levels, but we're in the same neighborhood. The S&P 500 is trading at multiples that historically only make sense if everything goes perfectly for the next decade. Let me put this in plain terms. When you buy a stock, you're buying a piece of a business. That business produces earnings. And you're paying some multiple of those earnings. Right now, for a lot of companies, you're paying 25, 30, sometimes 40 times earnings. That means if nothing changes, if the company just keeps earning what it's earning today, it'll take you 25 to 40 years just to get your money back from the earnings. Now, that might be fine if we're talking about a wonderful business that's going to grow earnings at 15% a year for the next decade. But how many businesses actually do that? Not many. And certainly not as many as the market seems to think right now. The second thing I'm seeing is debt, leverage, borrowed money. You understand, debt is like gasoline. A little bit in the tank, and your car runs great. Too much spilled around, and one spark turns into a disaster. And right now, we've got debt everywhere. Corporate debt is at record levels. Government debt is at record levels. Consumer debt, same story. Here's why that matters to you. When everything's going up, debt looks smart. You borrow at 5%, you make 10%, you pocket the difference. Brilliant. But when things turn, debt becomes an anchor. It doesn't go away just because your assets went down. You still owe the same amount, but now you're worth less. And that's when people get forced to sell at exactly the wrong time. I've seen this pattern my whole life. Someone buys stocks on margin because they're so confident. The stocks go up. They feel like a genius. They borrow more. Then something happens. Doesn't even have to be a crash. Just a little dip, 10, 15%. Suddenly, their broker's calling and asking for more collateral. They don't have it. They're forced to sell, and they sell right into the teeth of the decline. Third thing, and this is subtle but important, is where the confidence is coming from. Right now, a lot of people are confident not because they understand business or economics, but because things have been going up. That's it. That's the whole analysis. It went up last year, so it'll go up this year. That's not investing. That's inertia with a brokerage account. You know what's interesting? In my office, I can pull up a chart of almost any market crash in history. And if you look at the 6 months before the crash, you almost always see the same thing. New investors flooding in, trading volumes going up, people who never cared about stocks suddenly giving advice at dinner parties, confidence everywhere. And here's the thing about confidence. It's contagious going up and it's contagious going down. When everyone's confident, it feels silly to be cautious. You feel like you're missing out. But when everyone gets scared, and they will, that confidence evaporates faster than morning dew in July. Now, let me tell you about something else I'm watching. The quality of earnings. A lot of companies right now are reporting great numbers. But when you dig into how they're getting those numbers, it gets less impressive. Stock buybacks funded by debt, accounting games that push revenue forward or push costs backward, projections that assume everything goes right. I always look at what a business would earn in a normal year, in a bad year, and in a great year. And I ask myself, what am I paying for each of those scenarios? Right now, a lot of stocks are priced like every year from here on out is going to be a great year. That's not realistic. Here's another piece. Interest rates. For over a decade, we had rates near zero. That's not normal. That's emergency medicine. And when rates are that low, it does funny things to valuations. It makes expensive things look reasonable because the alternative, cash, earns nothing. But rates aren't zero anymore. And when you can get 4 or 5% in a treasury bill with no risk, suddenly paying 30 times earnings for a stock doesn't look as attractive. This is basic mathematics, not opinion. When the risk-free rate goes up, the price you should pay for risk goes down. The market's starting to figure this out, but slowly, very slowly. And then there's the behavior I'm seeing. Retail investors piling into things they don't understand. Meme stocks, crypto, SPACs, things with no earnings, no cash flow, just stories. Now look, I'm not saying every one of these is worthless, but when people are buying things purely because they're going up, purely because someone on social media said so, that tells you something about where we are in the cycle. You've also got companies going public that have never made $1 of profit and have no clear path to making one, and people are bidding them up on day one by 50, 100%. That's not rational analysis. That's speculation. And there's a time and place for speculation, but you better know that's what you're doing. My partner Charlie used to say, and he was right, that the first rule of compounding is to never interrupt it unnecessarily. And the way you interrupt compounding is by losing money you can't afford to lose. When you stretch for yield, when you buy things at prices that don't make sense, when you use leverage, you're putting your compounding at risk. Here's what all of this adds up to. We're in a market where expectations are very high, risks are being underpriced, and the margin of safety, the cushion between what you pay and what something's worth, that margin has gotten very thin. Not everywhere, but in enough places that it worries me. In the next part, I'm going to show you how these kinds of situations don't just hurt Wall Street. They ripple out and hit regular people, people who thought they were being safe, people who trusted the wrong advice, because understanding that connection, that's crucial to protecting yourself. You know, a lot of folks think that when the market gets into trouble, it's just a problem for rich people and Wall Street traders. That's not true, not even close. When the financial system starts to crack, it spreads everywhere. And it hits ordinary people the hardest because they're the least prepared and they've got the least cushion. Let me explain how this works. Let's say you're a teacher in Ohio or a nurse in Florida. You don't own any individual stocks. You've got a 401 that your employer set up. Maybe you've got $20,000, $30,000, $40,000 in there. You're not paying attention day to day because you're busy living your life. And that's fine. That's actually smart most of the time. But here's what you might not realize. That 401, it's invested in mutual funds. And those mutual funds own stocks and bonds. When I sell Apple or Bank of America, when big institutions start getting cautious, that affects the value of what's in your account. Not immediately, not dramatically at first, but it starts. Now, that's just the beginning, because the real damage doesn't come from the market going down 10%. People can handle that. The real damage comes from what happens next in the broader economy. And this is where it gets personal for everyday folks. See, when asset prices fall, when stocks drop, and real estate softens, and bond portfolios lose value, something psychological happens to people who own those assets. They feel poor. And when people feel poor, they spend less. They cancel that vacation. They hold off on buying a new car. They stop going out to dinner as much. You understand, this isn't about being poor. This is about feeling the wealth effect in reverse. And when millions of people pull back on spending at the same time, that's when businesses start to feel it. The restaurant where you work sees fewer customers. The car dealership cuts staff. The hotel reduces hours. My friend, I've seen this cycle play out over and over. It starts in the financial system, but it ends up in real communities affecting real people who never speculated on anything. They were just trying to get by. And suddenly their hours get cut, or their small business sees revenue drop, or their job disappears entirely. Let me give you a concrete example from 2008. I knew people, good people, who lost their jobs, not because they did anything wrong, but because the company they worked for couldn't get credit. The banks stopped lending, and when banks stop lending, businesses can't make payroll, can't buy inventory, can't function, so they lay people off. And here's the cruel part. The same person who just lost their job, they've also got a house that's now worth less than their mortgage. They've got a 401 that's down 40%. They've got credit card debt at 18% interest. And now they've got no income. That's not three separate problems. That's one big interconnected crisis. And it all traces back to what started in the financial markets. Now, banks. Let me talk about banks for a minute because this is important. When I sold a huge chunk of Bank of America, people ask me why. It's a good bank. Management's solid. They make money. All true. But here's what worries me. Banks are built on confidence and liquidity. Take either one away, and even the good bank can get into trouble fast. You've got your money in the bank right now. Checking account, savings account, whatever. You think that money's just sitting there in a vault. It's not. The bank lent most of it out. That's how banking works. They take your deposits, they lend them to other people, and they make money on the spread. Fine. That works great as long as everyone doesn't want their money back at the same time. But when confidence cracks, when people start to worry, they want their cash. And if enough people want their cash at once, the bank's got a problem. Because they can't call in all those loans instantly. The money's tied up in mortgages, business loans, and car loans. So what happens? The bank has to sell assets, often at a loss, to raise cash. And if things get bad enough, the bank fails. Now, we've got FDIC insurance, so small depositors are protected up to $250,000. That's good. But if you're a small business with $1 million in your operating account, or if you've got retirement savings above the limit, you could be in trouble. And even if you're insured, there's a delay. Try running a business when your bank account's frozen for 2 weeks while the FDIC sorts things out. This ripple effect, it doesn't stop with banks. When banks get cautious, they tighten lending standards. Suddenly, the small business owner who could always get a line of credit to cover inventory, they can't get it. The young couple trying to buy their first home, they can't get approved even though they've got good credit. The farmer who needs to borrow for seed and equipment, the bank says no. And when credit dries up, economic activity slows down. People can't buy homes, so construction workers lose jobs. Businesses can't expand, so they don't hire. Consumers can't borrow, so they stop spending. It all feeds on itself. You know what else happens? Pension funds get hit. State and local governments, they've got pension obligations to retired teachers, firefighters, and police officers. Those pensions are invested in the market. When the market drops 30, 40%, those pension funds go from fully funded to seriously underfunded. And then you've got states raising taxes or cutting services just to keep the pension checks going out. Let me tell you about another connection people miss. Commercial real estate. When businesses struggle, they close locations, they don't renew leases. Suddenly, you've got empty office buildings and shopping centers. The owners of those properties, they borrowed money to buy them. They're counting on rental income to pay the debt. No tenants, no income, they default. The banks that lend them the money take losses. And we're right back to the banking problem I just described. Insurance companies too, they invest premiums in bonds and stocks. When those investments lose value, insurance companies get squeezed. Some cut back on what they'll insure. Some raise premiums. Some, in extreme cases, fail. And if you're counting on an insurance payout for anything, you could be in for a nasty surprise. Here's the bottom line. The financial system is interconnected in ways that most people don't see or think about. When problems start at the top with overvalued markets and too much leverage, those problems flow downhill, and they flow fast. By the time you realize what's happening, by the time it affects your job or your business or your savings, it's too late to prepare. You're in reaction mode. And reaction mode is where mistakes get made. In a moment, I'm going to take you back through history, not to bore you with dates and numbers, but to show you what it actually feels like when one of these things unfolds. Because if you understand the pattern, if you recognize the feeling, you'll be able to keep your head while everyone around you is losing theirs. And that's worth more than any hot stock tip I could ever give you. Let me take you back to 1987, October. I was 57 years old, already running Berkshire for over 20 years. I thought I'd seen everything. And then on October 19th, the market dropped 22% in one day. One day. The largest single day percentage decline in history. Now, here's what I want you to understand about that day. It wasn't that something terrible had been announced. There was no war. No president got shot. No banks had failed that morning. The market just fell because it fell. Selling fed on itself. Computer trading programs, which were new back then, started automatically selling when prices hit certain levels. That triggered more selling. And pretty soon it was a stampede. I remember sitting in my office in Omaha watching the tape, and the feeling wasn't panic for me, but I could feel it everywhere else. Phones ringing off the hook. Brokers couldn't keep up. The systems were overwhelmed. People were trying to sell and couldn't even get their orders through. And when they finally did, the price was way lower than they thought. You know what the interesting part was? The morning of October 19th, if you had asked most investors how they felt, they would have said fine. Confident, maybe a little concerned about some technical indicators, but nothing serious. By the end of the day, grown men were in tears. Fortunes disappeared. Not because the businesses changed, but because the price everyone agreed to pay for those businesses changed dramatically. But here's the lesson. If you held on, if you didn't sell in that panic, within 2 years you were back to even. Within 5 years you were way ahead. The businesses kept operating. They kept earning money. The panic was temporary. The businesses were permanent. Now let me tell you about a different kind of crash. The dot-com bubble in 2000. That one built slowly over years. The internet was new. Everyone could see it was going to change the world. And they were right about that. But what they got wrong was thinking that every company with a website was going to be worth billions. I watched companies with no revenue, no profits, no real business model go public and see their stock price triple on the first day. Kids in their 20s became paper millionaires. Respected investors were buying things they didn't understand just because they were going up. And if you tried to be cautious, if you said, wait a minute, this doesn't make sense, people looked at you like you were an old fool who didn't get it. Charlie and I, we got criticized heavily during that time. People said we didn't understand technology, said we were dinosaurs. Our stock underperformed the NASDAQ by a huge margin. And you know what? That was fine with me because I understood something they didn't. I understood that businesses need to make money eventually, not in some distant future, but in a reasonable time frame that you can actually calculate. When that bubble burst, it wasn't as quick as in 1987. It was a slow bleed over 2.5 years. The NASDAQ dropped about 80% from peak to trough. 80%. Companies that were worth $10 billion went to zero. Not down 90%, zero, gone. And all those paper millionaires, most of them lost everything because they never sold. They rode it all the way down believing it would come back. The painful thing about 2000 was that a lot of ordinary people got sucked in right at the top. They'd heard their neighbors bragging about tech stocks for years. They'd felt left out. So finally, in 1999 and early 2000, they jumped in, bought mutual funds full of tech stocks, bought shares of companies they'd never heard of, and then they watched it all disappear. My friend, the worst position you can be in is buying something you don't understand at a price that doesn't make sense just because you're afraid of missing out. That's not investing. That's gambling. and the house always wins eventually. Then came 2008. That one was different again. That was about housing and leverage, and derivatives so complicated that even the people creating them didn't fully understand the risk. I've told this story before, but it's worth repeating. In 2006 and 2007, I was looking at banks and investment firms. The numbers looked great on the surface. Record profits, big dividends. But when you dug deeper, when you looked at what they owned and what they owed, it was terrifying. They'd taken mortgages, bundled them together, sliced them up, sold pieces to other institutions who then bundled those pieces together and sliced them up again. It was layer upon layer of complexity. And buried in all that complexity was a simple truth. A lot of people had borrowed money to buy houses they couldn't afford. When housing prices stopped going up, the whole structure started to collapse. I remember March 2009. The market had been falling for over a year. People were genuinely scared that the entire financial system might collapse. Banks were failing. The government was stepping in with bailouts. Unemployment was shooting up. And the stock market was down about 50% from the peak. I wrote an article that month saying I was buying American stocks. People thought I was crazy. They said it was going to get worse. And you know what? They were right. It did get a little worse for a few more weeks. But if you bought, when I said to buy, even though it felt terrifying, within a few years, you doubled your money. Within 10 years, you'd made 4 or 5 times your money. Here's what all these crashes have in common. In every single case, right before they happened, most people thought things were fine. They had explanations for why high prices made sense. They had reasons to believe it was different this time. And in every case, when the crash came, the same people panicked and sold at exactly the wrong moment. But here's what else they have in common. The people who stayed calm, who understood what they owned, who had cash to buy when things got cheap, those people came out ahead. Not just a little ahead, way ahead. Because the greatest opportunities come when everyone else is terrified. You see, crashes don't destroy value. They reveal it. They separate real businesses from fantasies. They punish speculation and reward patience. And most importantly, they create opportunities to buy wonderful things at reasonable prices. I'm not telling you these stories to scare you. I'm telling you so you recognize the pattern. So when you feel that feeling, that mix of confidence and fear and confusion, you know what's happening. You know you're not the first person to feel this way. And you know that how you respond in that moment will determine your financial future more than any other decision you make. In the next part, I'm going to walk you through exactly how a crash unfolds, step by step, not the theory, but the actual mechanics of what happens. Because when you understand the sequence, when you can see it coming even a little bit in advance, you can position yourself to survive it and maybe even profit from it. Now, let me walk you through the actual mechanics of how these things unfold. Because if you understand the sequence, you'll recognize it when it's happening. And recognition gives you time. Time to think, time to act, time to avoid the mistakes that wipe people out. It usually starts with something small, not a catastrophe, just a crack. Maybe a major company reports disappointing earnings. Maybe a bank discloses some unexpected losses. Maybe a foreign market drops sharply overnight. Whatever it is, it's not enough to cause panic by itself. Most people shrug it off. They say that's just one company or that's overseas. Doesn't affect us. But that little crack, it does something psychological. It plants a seed of doubt. And once that seed is planted, people start looking around differently. They start noticing other things they'd been ignoring. Valuations that seemed reasonable yesterday suddenly look stretched. Debt levels that seemed manageable suddenly look heavy. Confidence starts to waver. Here's what happens next. The smart money, and I mean the institutions have been around long enough to recognize the pattern, they start getting cautious, not selling everything, not panicking, just trimming positions, taking some profits, raising cash. You won't see headlines about this. It's quiet, but you can see it in the volume. You can see it in the bid-ask spreads widening. The liquidity starts to thin out just a little bit. Now we get to a critical phase. Somebody takes a hit. Could be a hedge fund that was using leverage. Could be a bank with bad exposure to something. Could be a pension fund that needs to meet redemption requests. Doesn't matter who it is. What matters is they need to sell, and they need to sell now. Not at a good price, not when the market recovers. Now, when forced selling starts, prices drop faster. And this is where things get interesting. Other investors see prices dropping. They start to worry. Some of them are also using leverage. When the value of their holdings drops, they get margin calls. Their brokers say, put up more money or we're selling your positions. Most people don't have extra cash sitting around. So their positions get liquidated, which pushes prices lower, which triggers more margin calls. You see how this feeds on itself? Meanwhile, the business media catches on. Now you got headlines. Market drops 5% on heavy volume. Investors flee to safety. Warning signs flash red. And every person watching at home, every person checking their phone, they see these headlines, they open their brokerage app, they see their account is down, and they start to feel something in their stomach. You understand, up until this point, most regular investors haven't done anything. They're still watching, still hoping it's just a temporary dip. But the headlines keep coming, the drops get bigger, and now they're thinking, should I get out before it gets worse? Here's where human nature takes over. People hate losses more than they enjoy gains. Psychologists have proven this. Losing $1,000 hurts about twice as much as gaining $1,000 feels good. So when people see their accounts dropping day after day, the pain builds up, and eventually they can't take it anymore. They sell. The problem is, by the time regular investors are selling, they're selling to the people who've been waiting with cash. They're selling at depressed prices to folks like me who are looking for bargains. They're transferring wealth from their pockets to someone else's, and they're doing it because they can't handle the emotional pain. Now, let me tell you what happens in the broader economy during this. Credit markets seize up, banks get scared, they stop lending to anyone who's not absolutely pristine. Businesses that were counting on rolling over their debt, on refinancing, they can't. Some of them have to file for bankruptcy, not because they're unprofitable, but because they can't access credit. The housing market freezes. People who need to sell can't find buyers. People who want to buy can't get mortgages. Prices start dropping because the only transactions happening are desperate sellers meeting bottom fishing buyers. And every house that sells for less than the previous one resets everyone's expectations lower. Unemployment starts ticking up. Companies that were planning to hire put it on hold. Companies that were marginal start laying people off. Consumer confidence drops. People stop spending on anything but necessities. Restaurants see traffic drop. Retailers see sales decline. And they respond by cutting staff, which makes the unemployment worse, which makes spending drop more. You see the cycle? It's all interconnected. And it all traces back to that initial crack, that first seed of doubt that triggered a cascade of fear and forced selling and economic contraction. Here's something else that happens during crashes. Correlations go to 1. Normally, different assets move differently. Stocks go up while bonds go down. Some sectors rise while others fall. Diversification works. But in a real panic, everything drops together. Stocks drop, bonds drop, real estate drops. Even gold sometimes drops because people need cash and they sell whatever they can sell. The only thing that holds value is actual cash and short-term government securities. That's it. That's why I hold so much in treasury bills. When everyone else is desperate for liquidity, when they're selling good assets at terrible prices because they have to, that's when cash is king. That's when you can pick up wonderful businesses at fractions of what they're worth. Now, let me tell you about the recovery, because this is important too. The bottom doesn't announce itself. No bell rings. In fact, the bottom usually happens when the news is at its worst. When unemployment is still rising, when bankruptcies are still being announced, when every expert on TV is saying it's going to get worse. Why? Because by that point, all the forced sellers are done. Everyone who was going to panic has panicked. The only people left are the ones who are holding for the long term and the ones who are looking to buy. And when there are more buyers than sellers, even if it's just a few more, prices start to rise. The recovery often comes fast, not always, but usually, because stocks fell too far. They overshot on the downside just like they overshot on the upside. And when people realize the world didn't end, when they see businesses are still operating and earning money, they start buying again. Sometimes the first year recovery sees gains of 30, 40, even 50%. But here's the cruel part. Most of the people who sold in panic aren't buying. They're still scared. They're waiting for more certainty. They're waiting for the market to really prove it's safe. And by the time they feel safe enough to buy back in, they've missed most of the recovery. They sold low and bought high. The exact opposite of what you're supposed to do. My friend, I've just described a pattern that's played out over and over throughout history. The details change. The triggers change. But the sequence, the psychology, the mechanics, they're always the same. And right now, we're somewhere in the early part of that sequence. Not at the crash yet, but close enough that I can see it coming. In the next part, I'm going to give you the rules, the specific principles you need to follow to not just survive what's coming, but to come out ahead. These aren't complicated, but they require discipline. And discipline is what separates the people who build wealth from the people who watch it disappear. All right, now we get to what really matters. What do you actually do? Not theory, not philosophy, concrete rules you can follow starting today. And I'm going to be very direct with you here because this is where most people mess up. They understand the diagnosis, they nod along with the history. But when it comes to action, they freeze or they do the opposite of what they should. Rule number one, know what you own and why you own it. Sounds simple, but most people fail this test. If I woke you up at 3 in the morning and asked, why do you own that stock? Could you give me a clear answer? Not because it went up, not because my brother-in-law recommended it, a real answer about the business, what it earns, and why those earnings are likely to continue. If you can't answer that question, you shouldn't own it, because when it drops 20 or 30%, and it will at some point, you won't know whether to buy more, hold on, or sell. You'll just be guessing, and guessing with your money is a great way to lose it. Rule number 2, only invest money you won't need for at least 5 years, preferably 10. This is critical. The stock market is not a place to put money you need next year or even in 3 years. It's too volatile, too unpredictable in the short term. If you're going to need money for a down payment, for college tuition, for any specific purpose in the near future, that money should not be in stocks. Do you understand why this matters? Because when you invest money you might need soon, you're forced to sell on someone else's timeline, not yours. And that someone else, that could be the market, could be your circumstances, usually picks the worst possible time. But if you know you won't need the money for a decade, you can ride out any storm. You can even buy more when prices are low. Rule number 3, diversification is protection against ignorance. If you know what you're doing, if you really understand businesses, you don't need to own 50 stocks. But most people don't know what they're doing. And that's fine. That's normal. So you diversify. You own a broad index fund. You spread your risk across many companies, many sectors, many geographies. Here's what I'd tell most people. Own a low-cost S&P 500 index fund. That's it. Don't try to pick individual stocks unless you're willing to do the work to really understand them. Don't buy sector funds betting on technology or energy. Don't chase whatever's hot. Just own the index and get on with your life. Rule number 4, price matters. This is where people get emotional. They fall in love with a company or a stock, and they forget that price is what determines their return. A great company at a terrible price is a terrible investment. A mediocre company at a wonderful price can be a wonderful investment. How do you know if the price is reasonable? There's no perfect answer, but here's a simple test. Look at the PE ratio. That's price divided by earnings. If it's above 25 for the overall market or for a specific stock, you're paying a lot. You're betting on strong growth. Make sure that growth is realistic, not just hopeful. Rule number 5, don't use leverage, ever. I don't care what the opportunity is. I don't care how confident you are. Borrowed money in investing is dangerous. It magnifies your gains when you're right, sure, but it magnifies your losses when you're wrong. And it can force you to sell at the worst possible time. If you've got margin debt right now, pay it off. If you've got borrowed money in investments, get out of that position. The few extra percentage points you might gain aren't worth the risk of losing everything. Rule number 6, keep learning but ignore most advice. There's a difference between education and noise. Reading annual reports, that's education. Understanding how businesses work, that's education. Watching financial TV with people screaming about what's hot today, that's noise. Reading predictions about where the market's going next week, that's noise. The best advice usually comes from people who have no stake in your decision. And often the best advice is the boring advice. Save more, spend less, own good businesses, be patient. That doesn't sell newsletters, but it builds wealth. Rule number 7, have a plan for different scenarios. Hope is not a strategy. You need to think through what you'll do if the market drops 20%, 30%, 50%. Not in theory. Actually, write it down. If the S&P falls 20% from here, I will do X. Maybe X is buy more. Maybe X is hold steady. Maybe X is rebalance. Doesn't matter what X is as long as you've decided in advance. Why does this matter? Because in the moment when things are falling apart, you can't think clearly. Your emotions take over. But if you've already decided what to do, you just follow the plan. You don't have to make decisions when you're scared. Rule number 8, and this might be the most important one, don't panic, ever. I've never seen a situation where panic helped. Panic makes you sell at the bottom. Panic makes you buy at the top because you're panicking about missing out. Panic clouds your judgment and leads to decisions you'll regret. When you feel panic rising, and you will at some point, stop, step back, go for a walk, don't look at your account for a few days. Remember that the businesses you own are still operating. They're still making products, still serving customers, still earning money. The stock price is just what other people are willing to pay today. It's not the value of the business. Let me give you one more rule. Rule number 9. Think about taxes. This isn't exciting, but it matters. If you sell a winner, you're going to pay capital gains tax. That's 15 or 20% for most people, gone immediately. So before you sell, ask yourself if it's really worth it. Are you selling because the business has deteriorated? Or are you selling because you're worried about short-term price movements? If you hold for the long term, you defer those taxes. The money stays invested and keeps compounding. That's a huge advantage. Don't give it up lightly. I'm going to leave you with the philosophy that's guided me for 70 years. Investing is not about being smart. It's about being rational. And being rational is a lot harder than being smart. Here's a principle that's guided my life. Never risk what you have and need for what you don't have and don't need. If you follow that one principle, you'll avoid most of the disasters that wipe people out. Here's another truth. You will make mistakes. I've made mistakes. Every successful investor has made mistakes. The question is not whether you'll make them. The question is whether you'll learn from them and whether they'll be small enough that you survive them. Let me close with this. The market is going to do what it's going to do. You can't control it. You can't predict it. What you can control is how you react to it. You can control whether you panic or stay calm, whether you sell or hold, whether you let fear drive your decisions, or whether you rely on rational principles. Stay rational, stay patient, and I'll see you on the other side of whatever comes next.